So we're expecting an interest rate decision from the Federal Reserve south of the border today. Let's get more from David Dietze, Chief Investment Strategist at Dietze Wealth Management Group. David, thanks very much indeed for joining us.
Andy, a pleasure to be with you today.
What is your call? Do you think the Fed will cut?
No, I don't. I think policy is going to be sitting tight. There's just a 3% chance, according to federal fund futures, that there would be a change. I think what's going to be a lot more interesting is the press conference afterward with Jerome Powell, because people are going to want to know, what does the outlook look like? What's policy going to be going down the road? And of course, he's under tremendous pressure from the president, from the Trump administration to lower interest rates. But I mean, we just saw a very strong GDP report for Q3. We've seen inflation not moving back down toward the 2% target. We've got stock market at all-time highs, and some indicators of inflation, perhaps like the precious metals and other commodities, are flashing warning signs as they hit all-time highs, even on an inflation-adjusted basis.
So the Fed finally halting the cuts because, as usual, the economy sends mixed signals. It's hardly surprising with a huge and complicated beast like the U.S. economy.
Yeah, absolutely. Of course, we have to realize that whatever he says may be overshadowed because there's some rumors that perhaps President Trump announces his pick to replace Jerome Powell this coming week. Whoever he selects, however, I think market participants can take comfort in the fact that it will be a more dovish approach than Jerome Powell is taking. And guess what? Looser monetary policy, lower interest rates is really manna from heaven for stocks, at least in the short term. And so that's kind of a positive going forward here.
Broadly, how are you playing the market right now, David? Are you steering clear of some of the massive AI names, the so-called hyperscalers?
I think it's very appropriate here to be rebalancing portfolios, take some profits in some of those, the big AI names, mega cap techs, and join the trend, which we've seen now, of a broadening market. Add money to mid caps, add money to small caps, add money to sectors that have been left behind a little bit, including like healthcare, for example. And of course, the overseas trade continues strong. We're seeing some weakness in the dollar here today. That only helps create better value for American investors investing overseas.
And what is your feeling about, there's a lot of optimism about copper right now. I don't know if you spend much time on the mining stocks, but are you trying to own materials right now, lithium, copper?
Well, I think material stocks makes a lot of sense now for a number of reasons. One is we know the inflation genie has not been put back in the bottle. And of course, commodities as hard assets have historically been a good hedge against inflation. Second, of course, we know that these materials to greater or lesser degrees are all so important for the build out of the data centers, for the build out of the AI economy. They're also very important in terms of the greener economy and greener energy production, so forth. And ultimately, as this economy turns with lower interest rates and gets stronger, we're going to need more energy. We're going to need all sorts of types. So I do think that there is a big push in commodities and securing what we need.
We are going to get earnings tomorrow from Boeing and GM, two great American industrial names. What are your thoughts on those two stocks, David?
Yeah, absolutely. So GM is, I think, their stock has not fully reflected the great job that Mary Barra is doing there. Of course, there's been a little change in strategy. They've reduced their focus on EV. They're increasing their focus on hybrid. But I do think with interest rates coming down generally, with a little bit of relaxation in the tariff tensions, I think a company like General Motors can do well. I think their earnings are going to come in very strong. But of course, again, with all these companies, it's all about that outlook. And I think that she's going to give a pretty upbeat view on the outlook going forward here. Boeing, of course, linchpin for the aviation economy, our largest exporter. They have recouped their losses in some of their tragedies and so forth with some of their planes, of course. Now the question is going forward, what can they do? Strong competition from Airbus, of course, and of course they're right also in the focus of the disputes on the tariffs and so forth. But we are seeing, for example, just the other day now, an airline in Africa has put a big order in with Boeing. So I think longer term, we're very optimistic on Boeing as well.
You have some stock ideas for us, and I'm sorry we're tight for time, Dave. F&G, annuities and life, and they're big in providing fixed annuities. What attracts you to this name?
This stock is a bargain at about 5 times earnings, 3.5% dividend, well below book value. And I think it has nothing to do with their very robust business selling basically annuities and other low-risk insurance products. Most of the shares have been owned by a parent, Fidelity National Life. They have decided in their wisdom to unload shares recently, which has now doubled the public float. The float couldn't handle it. And so the stock has now come down here. It's down about 35% in the last year. I think that does not reflect the fundamentals. This is an opportunity to pick up a well-run company at a bargain price.
And Kraft Heinz, it's seen as having been a mistake by Berkshire Hathaway. It has struggled. A lot of these consumer or packaged food companies have run into headwinds, but you see value there in Kraft Heinz?
Yeah, I do. And again, this is almost echoes the Fidelity situation insofar as here, a quarter of the shares are owned by Warren Buffett, Berkshire Hathaway, and they thought it was a great deal 10 years ago. It has not worked out for them. Now they're talking about selling, but when you own a quarter of a company, you just can't just turn around and dump the stock. The stock is now under pressure. There was just a regulatory filing that is furthering their ambitions to start selling those shares. But again, you've got a like 6.8% dividend, less than 10 times free cash flow for some of the world's most iconic food brands and so forth. They are planning to split the company up later on. So I think you've got a solid consumer staples play, which is now under pressure because of the fear of a fire sale by Warren Buffett's Berkshire Hathaway. I don't think they will do that. In any event, if you take a slightly longer term view, I think you do fine once those wins are past us. In the meantime, 6.8% dividend is not shabby.
And then finally, PayPal. What draws you to this one, David?
Yeah, so PayPal is one of your top fintech players. It's now trading for about 10 times earnings as people try and figure out where they're going to fit in the new e-commerce and AI agent commerce world. But they have just made a key acquisition of a company which is going to give them an orchestrated AI platform and allow them to take advantage to work their fintech magic in with some of the current AI models, including, for example, like Gemini, including like OpenAI, including like Copilot for Microsoft. So I think they are an experienced brand that is going to take advantage of these new ways for commerce, yet you were able to get in there at about 10 times earnings after the stock is down about 30% in the last year.
David, thank you very much indeed.
Thank you.
David Dietze, Chief Investment Strategist at Dietze Wealth Management Group.